Most people are just walking into 2026 hoping that they can lower their tax bill in the future. But here at Fross and Fross, we like to make sure that we're actually planning and taking advantage of things that we can control and looking at some different planning strategies to lower that tax bill in the future. So here's a couple of things that we're thinking about and telling clients this year. And I want to give you three different tax tips for 2026 to hopefully help you out, that you can come and talk to us about your personal situation. We can give you guidance on some of these things. First one's really easy. So most people take the standard deduction now. They've made it very difficult to itemize your deductions over the last couple of years. But one thing that they reintroduced, which is great, is that if you're taking a standard deduction, you can now, starting next year, do cash donation gifts. So not like dropping it off at Goodwill, but doing an actual check or cash to a charity, or you pay with a debit card or something online to a charity. You can now itemize $2,000 as a married couple, or $1,000 per taxpayer in charitable deductions on top of the standard deduction. So that's one thing that's coming back that's really easy, especially for a lot of people that are already giving on a monthly basis small amounts. You probably stop paying attention to it and keeping track of it. I would just say, hey, next year, keep doing that. Just start saving those receipts and keep track of it, so you can take advantage of an extra $2,000 deduction that you can utilize. The next thing also has to do with market volatility. The next two have to do with market volatility. And I think about that with this last year as a perfect example, where as of right now, the S&P 500, the largest 500 companies in the United States, that index that's following those 500 companies is set to finish the end of the year higher than it started at the beginning of the year. But that doesn't mean it went up in a straight line. And we experienced that through March and April this year, where the market was down. As uncomfortable as that is, there are two different strategies we can use when the market is volatile to help your future tax situation, potentially. The first one is a Roth IRA conversion. So you already have an IRA, a traditional IRA, and let's say the market's down and you have a lot of stocks that are down when the market is, like that was in April, and you've already been converting over to Roths. It's already part of your plan and strategy. You can actually just take some of those shares of that stock and move it over into the Roth IRA. Let's just say you had planned on doing a $10,000 Roth conversion at some point next year. That was your original goal and plan. Now, if you just sell some of your stocks and move over cash, that's fine. But if the market is volatile, one thing that you can do is take that same $10,000 number that you're targeting and move over more shares of whatever stock that you have, move over more shares, so that hopefully when the market does recover, now you've moved over more shares for that $10,000 amount that you put in, and it ends up rebounding, and it recovers and it does a lot better. So it's one way to take advantage of that. Think of that like repotting a plant, where you're not doing anything with the stock, you're just moving it. Same thing, you're not doing anything with the plant, you're just taking it from one pot, moving it to another. That's how that works with the Roth IRA conversion, using that strategy. The third thing is what's called direct indexing. Without getting too granular in it, I would definitely recommend that you reach out if you have any questions about this, but think of it this way. We are able now with technology, able to keep track and follow the S&P 500 if we wanted to, but only invest in 150 to 250 stocks that's in that S&P 500. And we can do so with a good degree of accuracy, give 1% up or down. But while the market's down, like it was in April, we can take advantage of that from a tax perspective and think of it like building up an account of tax benefits. Because what we're doing is, let's say that you owned Coke. Let's say that you had $10,000 of Coke on January 1st, 2026, and let's say something happens like it did this year, and in April, that same $10,000 that you had in Coke is now worth $7,000. What we could do is we could sell Coke and take that $7,000 that it's worth now, and let's say we just buy Pepsi as an example. So the goal is we're going to track that same performance throughout the end of the year. The goal is to have the same performance, but we're going to build up these tax losses. Think of it like a tax benefit. We're building up these tax benefits that you can use for different things, like offsetting a capital gain on a sale of a home. That's a big one, or a rental property, or maybe offsetting the sale of a business. If you're a couple years out, you have a long runway, you can start building up these losses. They don't expire. And it's not that your accounts are down. As long as the market, it's going to be tracking the market, whatever it's doing. So if the market's up, the account should be up. If the market's down, the account should be down. But all along the way, no matter what, any given year, just because the entire market is up on the screen or the TV doesn't necessarily mean all 500 companies in that index are positive. There's a lot of them that are negative throughout the year. So you can take advantage of those ones that are negative while still keeping that same positive return. That's the real benefit of that. It's really good for other things too, like really large positions in a single stock that you've held for maybe decades that is grown to be so large, and makes you kind of comfortable when that one company has something happen to it. It's swinging a lot up and down. One thing you can do is move that into an account like this with direct indexing and come up with a capital gains budget that you're comfortable with, and we can start chipping away at those capital gains by offsetting the gain with a loss, again keeping the performance the same, but offsetting that gain with a loss. So that's another way to take advantage of market volatility. So I leave you with three things. So charitable deductions on top of the standard deduction, Roth conversions by moving shares over to a Roth IRA when the market's volatile, and then also thinking about things like direct indexing for the money that you don't have in retirement accounts. So if you have any questions about this, feel free to reach out. We're always here. Take care. Bye.